Benchmark indices plunged for the third consecutive session, Sensex losing the psychological mark of 60,000 while the Nifty ending below 17,800. With Sensex tanking over 1,800 points in just 3 days, investors have lost nearly 6.56 lakh crore rupees in wealth. Boiling oil prices, persistent concern over global inflation and also likely Fed rate hike acting as the major headwinds for the domestic market to tumble. A worsening pandemic in India and profit booking ahead of union budget contributing to the selling spree today. Barring the Nifty metal and realty index, all sectoral indices were in the red today. Pharma being the biggest sectoral loser. Nifty IT was down 1.6%, dragging down, particularly by the likes of Infosys, TCS, HCL Tech. So, is it time then to press the sell button? Is it that the run of the bulls is over on Dalal Street? We have market expert Sharmila Joshi joining us now. Sharmila, take us through what you feel is really brewing here. I touched upon some of the factors at play, of course, but we've just seen consistent selling now for the last few days. Is this expected to continue?
I think, the things have changed. One is that while FIs have been sellers, for the first time we're seeing that domestic investors are also sellers. Both I think on the retail level as well as the domestic institutional level, one finds that for the first time we are hearing of net selling rather than buying. So this could this could have something to do with a couple of reasons. I think that people are just taking some money off the table because everybody is sitting on profits, and I think that really makes perfect sense. Because at the end of the day, unless you book profits and you enjoy the run, there is little point in really having profits on paper. And I think a bigger reason probably globally is the fact that somewhere there is a feeling that the first rate cut that we could hike that you could see from the Fed could be as much as 50 bits. So that has sort of unsettled global markets, and that's had its repercussions here. And it's also hit the sentiment of maybe domestic institutional investors. But I think, if you look at the numbers as well as the fact that we have a budget to look forward to, probably next week we should see some recovery.
Now, are we seeing some kind of rotation when it comes to, where the heavy selling is coming in, Sharmila? Because we're starting off, of course, with IT, pharma, metals, the only one holding forth today. So is this some kind of rotation we're saying, or is this just purely the markets, taking some of the froth off the table?
I think it is rotational, because I think that the sectors which have last gone up in the rally, they are the first that are seeing the selling coming in. So in that sense, it's rotational, but it's also, in a sense, a lot of these mid caps that have had really fabulous returns over this last year, people are just selling them and booking profit there, which, as I said, I think makes perfect sense. If you have a stock that's given you 300% returns, etc., I think it's time to shave off a little and probably relook at some other stocks which could give you a similar return. Because a stock that's given you 300% return, let's face it, I mean, unless you see it giving you another 300% return, it might just make better sense to book profits there partially and, invest somewhere else. So I personally don't think that there is too much cause for concern, but I think that the only concern one should have, and if you're entering, the market now, one is that traders need to be careful, because this has become a slightly volatile market in that sense. And I think that for me, the strategy that has worked is to try and buy stocks where I think earnings are, where earnings are good, and where I think that going forward, they can keep the momentum of earnings going in a sort of a tough environment. So whether it's a mid cap, preferably looking at good mid caps, or whether it is large caps, go with stocks where earnings are good.